Alrighty, let's go ahead and get started. Welcome everyone to TradeFinder Live. Great to be back with you all during this trading day and during trading hours. First and foremost, as always, we do need to cover our disclosure disclaimer agreement. The main thing to take away from this is that we are not licensed investment advisors in the United States, so nothing's to be taken as personal investment advice. This is always available on our website to be read in full detail at your leisure, or feel free to take a screenshot of it if you like, but that's the main point to take away. Other than that, the headlines for today are showing that Ray Dalio says today is like the 1970s, has it's comparable in the sense of investors should hold more gold than usual, and had an interesting discussion with Jeff about that earlier this morning on Hub Live, and interested to continue that conversation with Rob and hear his thoughts, along with interacting with you all, of course. So let's go ahead and kick off. Rob, you out there?
I am Zach. Hey, everyone. Welcome to TradeFinder Live. Hope you're having a great start to your week. Just a little bit of a grammatical correction there. Zach, it's Ray Dalio is actually how he pronounces his name. So he'd probably appreciate it since you're giving him props that you pronounce his name correctly.
I knew I had a 50-50 shot there, and it shows my age, I guess.
Yeah, a lot of the old guys are coming out and talking about old guys that have been around a while. And this is one of the things that I think is really interesting, is the fact that trading is one of the few careers where the older you get, the more valued you become. We know most of the time that we feel like as we get older, we're put out to pasture, whatever. But the more experience you have in this world of trading, the better. And while I'm talking about that, I have an event coming up that I'd like to invite everyone at TradeFinder to. It's called Generating Income from Trading. It's what professional traders do, and traders with experience like Ray Dalio, Paul Tudor Jones, all the guys that have been coming out of the woodwork over the past couple of days and throwing in their 2 cents. It's going to be held with Jeff Beamer and myself. Zach will put the link in the Q&A box. It's free. It's going to be on Wednesday, October 15th, so a week from tomorrow at 8 p.m. Eastern Time. And we're going to go through and talk about, I know the directional trading is fun. It is for me too. I enjoy it the most, but trading directionally is the hardest part of trading. It's the most difficult, getting the direction right. So what professionals do is they have some income-based strategies as a base into their portfolio. So we will discuss that. Not as volatile, doesn't generate the mind-boggling gains that you can get by being right on a directional trade, a la if you happen to be long AMD yesterday when the news was announced that they had a deal with OpenAI. You're not going to get that kind of stuff. But you're going to have a base and income to generate. And if you're someone like me that lives off of trading, don't have another job, then you want to have a consistent style of income, stream of income, I meant to say, so that when you might be getting a little bit off on the direction, et cetera, you need to have a little more patience, wait for a pattern to play out, et cetera. You know that you have that base coming in. So it's going to be a great event. Jeff has actually been trading even longer than I have. So you have two very experienced guys that you're going to be able to hear from for free. So it's really a no-brainer. So please join us for that again next Wednesday. And Zach will get that link in there for you to register. All right, so let's take a look at what's going on in the market and what's bringing all these guys. And, you know, it's another interesting thing is you don't hear from the old school guys as much. Have you noticed that? Even going back to Warren Buffett, doesn't show up very often. They just kind of do their thing. They don't need the limelight. They're not interested in it. They're not trying to build their business, et cetera. So you don't hear from them too often. It tells you that the fact that they're kind of coming out of the woodwork, that we're at a bit of a inflection point or a confusing time in the markets. And you can see today's move We've sold off a little bit. Been kind of what the MO has been the past few days. We open higher, and then we sell off, and then we've been able to rally into the close. Yesterday, we did close with a doji. You can see the little doji there, which meant that we might get a little more volatility today. It's not 100% like anything else, but a doji means indecision, and that's where we are. I have mentioned on the government shutdown that I thought the market would just play it off as political theater unless we get to the point where employees start missing a paycheck. We still have some time before that occurs, but I believe, if I'm correct, it would be next week, the 15th, when the first federal paychecks would be missed, and that's including our military, et cetera. And you can imagine that neither party wants to be flagged with our military, those out there serving for us, miss a paycheck. So I do kind of feel like they're going to get this figured out. But if by chance I'm wrong, and it goes past that, you're going to hear a lot more conversation on the financial networks and potentially more volatility in the markets. So we still are holding the 10-day moving average, even with a little bit of a tick down today. We're still in that ascending pennant pattern. We are almost to that 161.8% C wave extension within the wave three. For those of you that may be newer joining us, when we have a long wave three like this, likely there's going to be zigzags in there. The old Elliott wave rules were don't trade the wave three, even though pretty much everyone across the board agrees it's the strongest of all waves. But the reason they say stay away from it is you don't know where it's going to end and when that wave four correction is going to begin. And my viewpoint was, why do we want to ignore what's universally agreed upon as the strongest of all waves, even with people that have slight different variations of how they use Elliott wave? We use it from a trader's approach. I am not an Elliottician. I am not interested in labeling every single little move here and getting it with exact accuracy. We're looking at it as another technical indicator, and it is our lead technical indicator, but we back that up with other ones. And so using it from a trader's approach as just simply an indicator, not necessarily gospel. And then you can see lots of zigzags here within the wave three. So I've labeled this last one, the 100% extension is where we went. It's what you would expect with a 50% B wave correction. Oftentimes, within a wave three, you can get an extended C wave, which means it moves to the next fib level. That's right there at the 161.8% level, which would give us about 675 or a touch above on the SPY. And then we have to wait and see, because then the percentages historically change. It's not unheard of to have a second fib level extension on a zigzag within a wave three, but it's far less often that occurs. So we're getting to a point where I think we need to pay close attention here. They had an ex-Fed governor, he's not on the current FOMC, that said he'd be pretty comfortable just staying pat. Remember that there's already two more 25 basis point rate cuts priced in to the market. So the market is expecting and trading on the belief that by the end of the year, the Fed will cut 50 more basis points. What if they don't? That certainly would disappoint the market, and that could start the wave four. So let's just jump straight to the bond market here. And you can see a little bit of a tick up in prices today. It's kind of been a flip-flop on the past 2 days here with the bond market. So it looked like maybe we're going to break to the downside out of the TLT, which meant prices going down. The TLT indicates prices and yields move inversely. So with a tick down in price, yields ticked up. But now we're ticking back up in price, so that means yields are ticking back down. And the bond market has been doing all of these triangles for the entire year. The only directional moves on TLT have been the breakouts from the triangles, and then they go right back into forming another consolidating triangle. And so we'll see if this is a test of the breakout. There are three primary ways that stocks break out of triangles. The first one is just it breaks out and runs. And you saw that with GLD. We'll get to it when we get to that. And then um, the next one is it breaks out, tests the breakout, and then continues in that direction. And then the third primary way is you get a false breakout, which is why we have the rule you must have a follow through or confirmation day. The second day matters because the market loves to give head fakes. It loves to appear things are going one direction and then actually move the other way. And that catches a lot of retail traders off guard. And that's what professional traders want. So when we take a look at that, we had no idea which of those scenarios are going to play out, other than we know that, and barring some sort of a dramatic change into the close, that it's not one of the breakout and run in that same direction. But we could be testing the breakout and then continue down in price and therefore up in yields, or we could turn, head back higher, move up in price, and then down in yields. Looking at the TNX, you can see that in this case, also a move up in rates that occurred. So you don't really want to see that. We've been fairly much in concert across the board on the yield curve, which is a flat yield curve with rates going up or down, and it's doing it across all maturities. That's a flat yield curve. That's not necessarily the healthiest of all economies. We aren't getting any of the government inflation or jobs reports while the government shut down, so relying on the private sector. We had the ADP report that came out and showed that the jobs market is still weakening. And if the Fed is intent on that, seems like they would cut rates. But we don't know what the FOMC is going to do. They're going to do what they're going to do, just like I talk about with the market. It doesn't matter what you think the market should be doing. I learned that lesson a long time ago. No matter how much education, information, experience that you have, the market still doesn't care what you think. So the correct way to trade, in my opinion, the more successful way is to just listen to the market. Market's always right, which is quite interesting. You may have noticed that on YouTube, we have posted a video called Elliott Wave Haters. And in the Elliott Wave haters video, one of the things I addressed three primary issues, and one of them is that people use the fact that Elliott Wave relabels oftentimes, and more often than maybe other indicators, as a negative. But the market is always right. The market's ever changing. The market's dynamic. Don't you want an indicator that's as dynamic as the market, that will change as fast as the market does? So I just think it's just a talking point for people that may not have had success with Elliott Wave and are angry or whatever. But to me, it's one of the greatest positives of Elliott Wave is that it is quick to change. And if the charts are changing, if the market is changing, and your Elliott Wave count changes, you can make adjustments. And you can adjust rather quickly rather than waiting for some of the slower indicators that tend to be a little bit more lagging to catch up with what the market's doing. So anyway, get off my soapbox there, but you might want to take a look at that video on YouTube if you haven't. And it's on the Elliott Wave Options channel on YouTube. So we'll move over to the dollar, which is just kind of yawning right now. Looked like maybe we were going to try to break out and then came back down. And until we figure out, oh, I do want to go back to TNX for a moment because we do have a five-wave pattern very well set up. I got on my soapbox, and this is what I was going to show you. It's a pretty symmetrical five-wave pattern, again, with a lot of zigzags, very complex wave three. The wave four is right at a fib level, 38.2. And if we continue down on the lower end of the curve, that could be a good thing, or it could be a not so good thing. It could be a good thing in that when you have a flat yield curve, that means interest rates are pretty much stable across the curve from shorter maturities to longer maturities, pretty similar. What you find when you have a healthier yield curve, indicating a healthier economy, is what you would expect. Lower yields or rates on shorter maturities, higher yields or rates on longer maturities. It only makes sense that you should be able to gain a higher interest rate if you're committing to holding a bond or treasury longer. So a steeper yield curve is healthier, it's more normal. And this flat yield curve that we've been dealing with for, gosh, about a year and a half, it's not inverted anymore, but if things keep up, it could get there again, which would be a negative for the economy. All right, so we'll have to see if that, first of all, if the TNX on the 10-year, which is rates on the 10-year, I don't know if I mentioned that or not, but TLT is prices on the 20-year, TNX is actual rates on the 10-year. If the short end of the curve continues down, if the long end doesn't go down with it, then that would be healthy. We would be getting lower rates on the shorter end and maintaining or getting higher rates on the long end. We don't have to go up in rates on the long end. If it stays stable, but the short end goes down, that's still a step in the right direction for an indication of a healthy economy from the yield curve. But if yields go down on the 10-year and down across the board, then we're in the same boat of scrambling, trying to figure out this balance between the jobs market and inflation. So the dollar still staying sideways. It does have a pretty decent symmetrical triangle. We'll see which way it's going to break. It will likely break out of this consolidation at some point, and that's going to affect what I mentioned a little bit earlier, metals, which it's kind of mind-boggling to me. This is what you mentioned, Zach, that Ray Dalio said that people should be holding a little bit more gold than normal in their portfolios. Always been viewed from an asset allocation plan that having a little bit of physical gold in one's portfolio, or the ETFs. The problem, you hear all the stuff with the ETFs as far as longer term, is the belief that there is more gold spoken for on these ETFs paper than there actually exists. So if we ever had a economic calamity or whatever, and people were looking for gold as a mode of currency, et cetera, there could be a problem. So GLD, these are trading vehicles. These are not holding the metal for longer term in your portfolio. But gold just continues to power higher. This is not sustainable. There will be some sort of a correction at some point. I thought it would have come a lot sooner than now, but has continued to power up. But when you go vertically like this, you're going to get some sort of a correction. We're pretty separated from the 10-day moving average. We're far steeper than a 45-degree angle, which isn't what I prefer. But there's your example of the breakout from GLD of the triangle. Is the dollar going to do something this severe? I hope not, because that could spook the markets a little bit if the dollar begins to move that quickly. But you can see the potential that occurs. We exited our GLD position way back here because that was the rules of a triangle. You measure the mouth of the triangle, you take that price range from the point, and then you can expect either an upside or a downside breakout. Even any triangle can break either direction. The AI from the Hub organization, and if you are new and haven't heard this yet, or if you've been watching and for some reason haven't done it, you can go to hubb.com, get a free copy of this software and the free Elliott Wave. And I want to clarify, because every now and then there's a comment on the U.S. market update that someone doesn't agree with how I've labeled the Elliott Wave pattern. Well, I'm not labeling the Elliott Wave pattern. The algorithm within the software is, and they have programmed the algorithm exactly to the algorithm math, or whatever you want to say, phrase it, that Ralph Nelson Elliott wrote. So all I do is show up here and try to interpret it for you as best I can, but I'm not labeling the Elliott Wave count. So other things that we talk about within Elliott Wave is the fact that this is a very steep move. But back to the Hub organization, the software is free. The Elliott Wave is free. You do have an opportunity to subscribe to these AI signals if you'd like. You don't have to get the software, but it's there if you'd like. We've talked about Top Shot. which has been doing very well. Just exited the top shot alert on XEL before we started this session. So basically, that is where I cherry pick one of my favorite alerts for the week. And we have three primary portfolios in level three. And if you have the level three bundle, then you get the speculative portfolio for free. Top Shot can come from any one of those four portfolios, and it's a great deal. So, take advantage of that. You can go to the website. Might mean catch you off guard, Zach, but maybe if you can find that link, you can put that one in there as well. But we'll see how far gold can go. And then there has been some chatter, and I've been curious of this myself. Will silver play catch up? Whether it's SLV, which is the ETF for the metal silver, or SIL, which is an ETF for the silver miners. We'll see. But again, the AI nailed it. Look at that. We hit the AI target and we've backed off today. Just as soon as we got there, turned over. Now, what I was surmising or opining or curious about is whether or not silver is going to play catch up to GLD or gold. Because if I go back to the gold chart, not only did we greatly exceed the triangle breakout rules, the AI said, "Now you're not stopping at 330, you're going to 337," which we did. We pegged there for a while, and it's blown way past that. So you look at this area from where the AI target was to where GLD is. Could silver do the same thing? We have to keep in mind that it has reached the AI target. So if that was it and it moved back down, then AI nailed it. It still nailed it, but will silver exceed even what the AI forecast? And so the fact that the metals are moving like that when the dollar is still staying stable in that Goldilocks channel or scenario that I've been talking about for quite some time now, a number of months, but is probably going to violate that once that triangle breaks out. And then if we go and take a look at the cryptos, they've been responding well. We're getting a little bit of a pullback today, but as I mentioned to our subscribers on Evo Trader Live, as for subscribers at evotrader.com, even Bitcoin had gotten a little bit ahead of itself, at least as evidenced by the BITB, one of the ETFs that track Bitcoin. Very liquid in the options. Many people like IBIT as well because it has weekly options. BITB does not. So it just depends on if you're interested in the real short-term stuff or not. Regardless, they both have very liquid options, and they track Bitcoin pretty much the same. The big difference is the added consideration, I guess, of weekly options versus having only the standard monthly options. But we got a little bit too far, too fast. So we gapped up and took off. We had 4 straight big up days. So a down day is no big deal. So the fact that Bitcoin is coming back down today is not a concern. It's still above the 10-day moving average. And so what I mentioned yesterday is that this looks extended and perhaps we go through a little bit of backing and filling here. We had a situation where we actually had what I call dueling zigzag patterns. You don't see this very often. Oftentimes, not oftentimes, periodically you'll see dueling zigzags. And what I mean by that is that you have a zigzag in either direction that's qualified and confirmed, 2 different things. Again, LE wave terminology. But we had this, what makes this one so unusual is right at the 61.8% B wave correction on the upside zigzag. And then when we had this move up and we came back down and tested that B wave low, that created roughly a 61.8% potential correction for a downward zigzag. So to have them both at primary fib levels like that, 61.8, most people feel is the strongest of all, myself included, Fibonacci levels. The Fibonacci levels act as support and resistance. So that was kind of unusual, which is why I show that. Clearly, the upward zigzag is the one winning out. But once it becomes qualified, it just means you have to pay attention to it because it's a possibility that it it plays out in either direction. So we can probably just go ahead and take off this lower zigzag here since we had that upward breakout. But until that point, we didn't know which way the C wave was going to move in the zigzag, up or down. So again, pull back today, but nothing to be concerned about if you're long Bitcoin or long the BITB. Simply correcting the overbought condition, no security in any time frame, gets too far away from the 10-day moving average, at least not for long. And now we have Ethereum, which outperformed Bitcoin for a while. Now it seems you saw that chart that Bitcoin has retaken the reins and outperforming Ethereum a little bit. So they're flip-flopping back and forth. So if you're involved in both of them, you don't really care which one the leader is. But same scenario here, backing up a little bit back towards the 10-day moving average, but still above it and just correcting this bit of an short-term overbought situation or condition here. Looking at the VIX, this is where we need to add in a little caution, I think, because we have this really extended descending triangle on the VIX, and triangles work in the VIX just like they do on any other trading security, can break out either direction. So if we break to the upside, that seems to be the path of least resistance. A descending triangle does not necessarily mean we're going lower. Remember, any triangle can break either direction. We have all three of the major moving averages that I have on my screen, the 10, 30, and 50 at the exact same spot. That means that the consolidation is really getting towards a point of likely something's going to happen. Is there going to be some black swan event, something negative that we don't expect? Does the government shutdown last past those first federal checks to go out, and that creates more volatility? It could be as simple as that. A downside breakout is still possible. If the market turns and runs and things calm down, then perhaps we drift lower, but I don't think we're going to see a volatile breakout to the downside. The next support level is just not far away at 12.5. That's where we spent last summer. So you can see these spikes here. And it seems that that could occur more than the downside spikes or even a downside breakout. But either one is possible, and keep an eye on it. But this should keep some caution in the back of your mind on where we go from here when we're looking at those that triangle on the VIX. If we take a look at the Dow, we can see it's just kind of motoring up along the 10-day moving average. It's in a wave 5 where the SPY is in a wave 3. They're likely to all relabel and agree at some point, but for now we have 2 wave 3s, 2 wave 5s, and this nice 45-degree angle, in my opinion, is showing that it's not the retail trader. The retail trader is still trading those big tech stocks. The ones that are in the name are in the news all the time. Anything that has AI in its name or involved in AI at all is where the retail traders are living at the moment. They've got a lot of money. There's a lot of money in money market accounts. But it seems like here there's a little bit of maybe institutional rotation because that's what it looks like when institutions buy. They don't come in all at once. They nibble because they don't want to create the big spikes and draw attention to it. They don't want to create the big spikes because the more vertical things go, the more severe the corrections tend to be, which again is why I think we got to keep an eye on GLD. When that ends, we could have some significance to the downside. But for now, trending up, we are moving towards the upper end of the wave 5. We're nearing 100% extension, which is pretty far extended considering the wave 4 was pretty weak at the 23.6% fib level. It's not a strong fib level, but it did work this time. But I think the Dow is showing a little bit, getting a little bit extended as well. And then moving to the Qs, we take a look at the Qs. There's the other wave 3 along with the SPY, almost identical chart here where it's coming back down towards the 10-day moving average today. A weaker B wave correction in this zigzag. So you look for the 61.8% extension here. And then the second extension would be the 100%. But the target, that's why the C is right here, is always the first extension, the expectation of the C wave. We're not quite there yet. It's not too far away, just as we're not too far away from the target on the SPY either. And then the IWM, which is also acting backwards to the bond market, or did yesterday. Today, a little bit more in line. But normally, when rates go up, it's more difficult on the IWM. When rates go down, it's more positive. We got a little bit above the 10-day moving average yesterday, even though rates tick up a little yesterday. So that was unusual. And then back down today, which is odd, but just correcting to the 10-day moving average. So all the markets pretty much are still, from just a technical standpoint, hanging in there pretty darn well with the point of the 10-day moving average being the guide. A lot of people interested in the IWM. Been a lot of chatter. Most people view it as a risk on, risk off indicator. But if you're looking for a correlation, I always talk about this. Correlations exist until they don't. But one that's been pretty consistent over time is the IWM moves a little bit in concert with rates. It is the most rate sensitive of all the markets because there's smaller companies that need to borrow money. They need to borrow money to grow and expand. They don't have big war chests like Nvidia or Apple or the other ones that have tons of cash that they can use to grow. Small companies need to borrow money to grow and expand. So that's why they're so rate sensitive. And the fact that we're nearing the top end of the tap box here, another one that's in a wave 5 that's extended more than 100%, like the Dow. So which pattern is right? Are the S&P and the Qs right with their wave 3s? We get a corrective phase and then move up in the wave 5s? Or is the Dow and the IWM more correct that these wave 5s could be ending and then we move back? Both of them extended more than 100%. So in neither case, neither, however you want to pronounce it, moving all the way back to the previous 4, not looking for that. Once the wave 5 by Elliott wave rules passes 100%, you look for a correction down to a fib level, not the full-blown corrective move all the way back to the wave 4. And then some people say, well, does it really matter? Because when a wave 3 ends, you correct to a wave 4. When a wave 5 ends, you correct back towards the wave 4. And that's true. We could keep this labeling with still a corrective phase at some point, which the market will correct at some point. And the patterns just stay where they are because both would be forecasting the next move being a likely corrective move. But then you go back historically, and oftentimes they do relabeled to have the same type of an Elliott wave count. But I agree with those comments. Doesn't have to. We could have corrective phases in all the markets and still keep the labeling the way it is. Nothing's 100%. So just because historically they tend to come back in line or in concert with each other doesn't mean it's going to happen this time. And then we'll go to the energy market. We did finally get this oversold bounce that we were looking for in UNG. We were able to take it off here when we got a little bit overbought, a little separated from the 10-day moving average. So there's another evidence of that rule. No security any time frame gets too far from the 10-day moving average, at least not for long. Right back to the 10-day moving average. And now we're moving back up again in natural gas. And maybe we do finally get to that 15 point, but we took it off here because we were separated from the 10-day moving average and we had a gain. And there's no guarantee that we're going to get here to the 15. It's just the first area of resistance if UNG continues higher. And this was just a speculative alert here on the fact that that was a very long 5-wave pattern to the downside. Every time it tried to bounce up, it's the exact opposite of what's been going on in the equities markets, where we've been buying the dips, programmed into buying the dips. Here you were selling the rips. So anytime it went up, it was being sold into. You can see every single time it blipped up, And at some point, the sellers become exhausted. And that looked like that was getting a little long in the tooth to the downside, not calling for some massive run in UMG. Maybe it happens, but supply has been winning the whole supply demand argument. I've gone through that a lot, so I won't spend time doing that here so we can open it up to Q&A. But maybe we do get up there to 15, but we're already out of that one. And then oil, which has this big symmetrical triangle as well. This goes to the same thing that I was talking about with the dollar on, does it break out and test it and continue lower, or was that on TNX? You remember which one I was talking about there. But you can see it looked like we were breaking down. We've come back up, but we're not even to the 10-day moving average yet. So it could be the scenario where you break out, test it, and then you continue lower. But until we break that breakout low there, we have to keep the at least thought in our mind that this could be a false breakout and oil could take off to the upside. We don't know for sure which of those breakout patterns is going to occur yet. All right, Zach. So with that, we'll go ahead and I was going to show just a couple of international markets here before we move to the Q&A. China, the FXI, everyone's seen the charts of Alibaba, etc. It's had a nice move, pulling back a little bit here. The DXJ, we had alert on that in the past, which was Japan, and it had a big move up yesterday on some economic data that came out, but big gap move. So backing and filling is warranted here, but you can see that there's still an AI target here on the DXJ of moving up towards that 138 level. Maybe we get a little more sideways stuff here. There could be another entry there. All right, so just wanted to show those couple of markets, Zach, and now we can open it up to the Q&A.
Sounds great, Rob. Let's get right into it. Got a question here from Bruce on Poet, P-O-E-T.
Let's take a look. As always in this show, looking at some stocks that aren't the ones that you hear about day in and day out. Lower dollar stock here, making a nice move, at least early in the trading day. It's kind of giving that up as the market weakened. You can see it open, ran up here, and now we're trading towards the lower end of the trading range for the day, but even that's a little bit above the 10-day moving average. So you can see on the high of the day, it had gained separation from the 10-day moving average. So perhaps that's as far as we're going to go at this point in time. But from an Ellie wave standpoint, it's a pretty decent looking pattern. I would want to see maybe another day or two of something like this. It is in the wave 5 tap box. Then that tap box, by the way, stands for time and price projection. I use it more for price than time, but some real technical Ellioticians really get into time forecasts. Personally, I haven't had as much success using the time aspect as I have on the pricing. I just use it as a general guide and try not to get too specific on the timing. And as option traders, we can just go a little bit further out in time anyway. But when you see a pattern like that, I want to see what the DMI looks like, and that looks solid. You got the positive directional indicator moving up, the negative moving down, the ADX is moving up. It's above 20, it's getting above 25. So this little bit of a pullback, even though it's still positive on the day, is healthy. So you might be on a good one there. And then you add in the $5 and $10 rules of, just for those of you that may not have heard it before, stock companies, investment companies, mutual funds, etc., are not allowed to own stocks at single digits unless they are have their registered investment objective as aggressive growth. They can't own them before $5, but between 5 and 10, those with aggressive growth can own the single digit stocks. And then if it's an investment company, mutual fund, et cetera, that has growth in their name, they can go down to $10. so they can own a stock at $10. And so what ends up happening is there are far more investment companies with just the generalized growth than there are aggressive growth. And so what tends to happen is if it can break the $10 barrier, a lot more volume tends to come in if it's a company that has some institutional interest in it. It's got a ways to go before it gets to 10, but that's a possibility down the road. So just to wrap this up for now, it looks constructive. I see no reason to exit this if you already own it. And if you're looking for an entry, my opinion, anything below $10 is for the aggressive-minded traders. And if you are, we all have different risk tolerances. You know, whether you're more aggressive or more conservative. If you are aggressive minded, you could take a shot now.
Thanks, Rob. A couple of symbols for you from Manuel. First one's going to be AMT.
American Tower REITs, and gosh, these are going to be really dependent on what happens with rates. And REITs, real estate investment trust, for those that may not know what that means, but probably most of you do. We've got a nice little zigzag to the downside here. Look like we're going to try to base around 190, and it's broken down a little bit lower on just the concern that maybe, we have two things working in the housing market. One is the housing market's been hot for a long time. And when the housing market's hot, builders build, build, build. And then just like what normally happens, go a little too far, have a little too much capacity, and then the demand falls off a bit and prices come back down. And if rates aren't going to go as low as what maybe was hoped at one point in time, you can see why that's affecting anything that's got a little bit of a real estate touch to it. There's the zigzag. And you can see here's a perfect definition of the zigzag rule. The B wave is right at the 38.2% level. That gives you a 61.8% expectation on the C wave extension. And look, it pegged there for a month, right at that level. And now it appears that we're breaking lower. And the next level would be that 100% extension. So that's the first extension. And seems likely it's a little bit below the 10-day moving average, but seems likely that we're going to test that 100% extension, and then we'd have to look at it again. So I would say for now, and that's all we can do as technical traders, is analyze the charts that we have at the moment. It looks like it wants to drift perhaps just a little bit lower, and then we'll see if it can find some footing there.
Thanks, Rob. Let's follow it up with, NDM.
So we're continuing with the normal MO of TradeFinder with a lot of symbols that we don't look in day out.
Sorry,
right,
Rob. That's NDM, not NDMO.
Okay. Clicked on the wrong one. So this is on the Toronto exchange. That's why I just saw the NYSE and automatically went there. All these kind of stocks are taking off. The only concern here is that we are at a potential point of resistance. We're right around the 61.8% level. This is not a classic Elliott wave pattern. So when I see this kind of stuff, I tend to ignore the Elliott wave count because this is not how Elliott wave was designed to have a massive move down. It does show you, man, that is a perfect lead in to that generating income event that we have coming up next week. One of the portfolios that we use in that is when we find a stock that has a big move lower like this. This is what happens. I always used to talk about this in live events, that the stock kind of flatlines. It's like it's in shock that it had this big drop. And this generates a spike in IV in the puts, and we can create a strategy that allows us to benefit from that and generate some income. Again, it's not a home run directional thing, but look how long this went sideways after that drop, and now it's recovering itself a little bit above the 10-day moving average. So I would expect a little bit of resistance right here some backing and filling might be good. But if we could break where this wave 4 high is here, then I think there's a good chance you're going back to test those highs that occurred back in July. But this would be a little perilous to go long right now, even though it sure looks tempting when you see those two big up days. Um, but there's no guarantee that the 61.8% fib level is going to act as resistance. They just oftentimes tend to. So I would watch that high, the high of today, very closely. Um, and if it was me and I was in this one and I wanted to see if it could go higher, I would tighten my stops up a lot in case we do get some of that backing and filling. But if I wanted to stay in it, just tighten the stops.
Thanks, Rob. And as you referenced, don't forget to register for that generating income event. Lots of insightful and valuable information that's going to be covered in that event. So I'm dropping that link in the chat again. Next question I have for you is I've looked at over 100 charts that are sitting at the top of wave 3. In your experience, is that a precursor of some impeding an event in the market, or should we be more careful?
For me, um, being someone that was once an extremely aggressive trader, which can generate some amazing gains when you're right, but hurts a lot when you're wrong, and kind of got tired of that roller coaster in the stomach. I tend to be a little more cautious. Some of you may have noted that I tend to take off alerts even before they hit their target. If we can catch them on the way up, even if we don't catch the high, I'm okay with that. You have to make sure you don't go second guess yourself. You don't want to go back and say, oh gosh, I should have stayed longer. I could have made more, because that'll drive you crazy as well. But the long-winded answer to the question is when I start to see a lot of stocks moving up in these strong moves in these wave 3s, we're at least due for some sort of a pause. And I'm not calling for any sort of a big significant correction either. But this has just been a heck of a run. And we've got a lot of people saying that, the conditions are ripe. There's so much money on the sidelines that, we could have a huge move before the FOMO spike, that fear of missing out, that I thought we might get after the Fed meeting, which we didn't get. And that can kind of give you a blow off top type of scenario. There's a lot of people that think we're going to continue to creep up. But for me, again, you trade what the charts are giving you, and you don't necessarily want to shy away from a chart that's in a wave 3 because it could continue, but have caution in the back of your mind. It's not a back up the truck, load the boat, whatever, satirical phrase you want to use. But trade what the charts are giving us right now. But I do think that the more that happens, the more those extended wave 3s that we see, the closer we are to some sort of a correction.
Thanks, Rob. Next up, I got a question on FXI, which I know you covered, but specifically just quick thoughts on if it'll rip higher if the tariffs end up getting overturned.
Yeah, I think so. I was wrong on this, and well, I was bullish on China until, and I've referenced this a few times. They showed that video of President Putin and the head of China getting all chummy and seeming like they were coming to some sort of working agreements. I didn't think that was going to sit well with our administration, and I thought the tariff rhetoric might be turned up a bit. And it hasn't worked out that way. And so after just a brief move lower, we turned and headed back up in the China stocks. When we look at this chart, it's in the tap box, but it's zigging and zagging pretty nicely. And I do think, to answer the question, that if the Supreme Court goes against the president being able to enact tariffs, remember, Congress still can. And of course, the president will be lobbying Congress to pass the tariffs. It's just going to delay them and move it further out in time. So it'd be longer before they could be enacted again. but I do think you'd get a short-term pop if that occurs. So I'd be watching for that. But that the optic of Putin and President Xi didn't seem to affect things at all, other than for a day or two. It was just a quick day or two pullback, and then China started going back up again.
Thanks, Rob. Question on Disney.
Oh gosh, we haven't looked at that one in a while. Um, Disney has been a bit more volatile of late, as you can see, than is normal. But when you add in streaming and ESPN and everything else that's associated, it's a much different stock than when it was just theme parks and a little bit of the early days of the streaming. But you can see these big moves here. It's not the Disney that stock that I've known stock action of the past, but now we've calmed down a bit. This is a little more normal, lower volatility because it's such a big company. And this drift down in the wave five, we have moved into the tap box. We did go to, and again, not the most classic, but not the worst Elliott wave pattern either here. And with the 61.8% wave four, we could see this wave five drift on down. If the economy continues to weaken, it's going to kind of be a battle within Disney. The theme parks will probably not perform as well, but if everybody's staying at home, will the streaming service perform better? And so you could kind of make an argument either way. And I think that kind of a give and take, yin and yang, if you will, is kind of what's causing the less volatility in the stock. But for now, as long as it stays below the 10-day moving average, a bit of a continued drift lower seems to make sense here. But I don't, barring some disaster in the next earnings report, see anything too significant to occur there.
Thanks, Rob. Let's head over to Dell, DELL.
Yeah, they had news today. I don't know if it's their earnings report, but they did talk about some good numbers. And you can see we opened higher as the market moved lower. We've kind of based throughout the time that we've been doing this webinar, but we opened higher, sold off, and then been kind of going sideways. But there was the open on the news a little bit higher, and then still above the low of the day, but kind of trading right around where it was yesterday. If the market doesn't sell off into the close, then I think this might turn around and drift back up. On the high, it got just a bit away from the 10-day moving average, because you can see Dell's one of those stocks that really kind of hovers close to the 10-day moving average most of the time. And a lot of times people will ask that question of, how do you know when a stock is too far from the 10-day moving average, that rule that I talk about so often? And you have to, there is no hard cut percentage rule. You have to look at the history of each individual stock. Some get further from the 10-day moving average before you would consider it too far than others. And with Dell, it doesn't get very far away. And so on the high of the day, that's about as far away as we've seen over the last year or so. So the fact that it's come back down a little bit, I don't think is a problem. We do have another stock here with an extended wave five above 100% with a weak wave four corrective phase. Perhaps that relabels to where this is a 3 and that's a 4, but I'm not smarter than the algorithm, so we'll let it do its thing. Just a possibility. But for now, with that news today, as long as, and I keep qualifying things because I am getting more cautious as the rally continues. If barring any sort of a correction soon, I think Dell could even continue higher from here.
Thanks, Rob. I note that we're getting close to time for the session and want to leave time for your case study consideration for this week. So perhaps one or two more, and then we'll head over for that.
Sounds good. We'll do two more, and then we'll do this week's case study consideration.
All right, let's look at Palantir, PLTR.
I was wondering when that one was going to come up again. a darling of the retail crowd and love this stock. And we looked at this, was it yesterday or last week? And so I drew this line here where the previous wave five was. We backed up a bit again. When you go past 100%, you don't look for a move all the way back down to the previous four. You just look for a retracement down to a fib level to hold. This one held 61.8, right where the A wave high was on the zigzag on the way up. And now we're testing that level here. So if you're long Palantir right now, I don't see a reason to exit that position, but beware that this previous wave five is resistance and the resistance could hold. And if it breaks back down below the 10-day moving average, like it tried to do here, but even though it closed below it, there was no follow through or confirmation day. So right back above the 10-day moving average. So it's kind of in a little between a rock and a hard place here. It is holding the 10-day moving average, but also bumping its head against resistance. For me, I would just be patient on this one and wait and see if it can break this resistance level. If I was long already, I don't see a reason to exit yet, but I would be keeping a really close eye on that 10-day moving average. And if this resistance appears it's going to hold, and then we could be moving back down at least to the 50-day moving average. You can see that's what happened the last time it corrected in August, where we came down, but we just pegged that 50-day moving average, built a base, and then took off again. Kind of that launch pad effect that Zach and I used to talk about. So I'd keep an eye on it. If I was looking to go long, I would want it to break that wave five high first.
Thanks, Rob. Quick thoughts on QBTX.
Not a huge fan on these multiples of the of anything, even the quantum stocks. If you can get the timing right like this, then they're great. But they're designed to erode value if you're trading options because to get the leverage for the 2 times, 3 times, whatever, they also incorporate futures. So you have a double whammy on time decay. So they are very important. It's very important when trading these to get the timing right and to get it right on a short-term basis. And if you did on this, then you've enjoyed a nice couple of days. That's getting a little too vertical for me. That's getting a little too far from the 10-day moving average. So if you caught this move, great. I would be careful of some backing and filling here. Very similar to what occurred here, where you kind of went sideways, down a little bit, back up. That would be healthy to see that occur. And if we are going to continue higher in the whole tech world and people looking towards quantum in the future, et cetera, a good bit of a consolidation here. We're also at the big round number of 300, which kind of will add a little bit, I think, of resistance also. So great move. My personal disciplines would not allow me to enter on this kind of a move. I would want to watch and see. Every now and then they keep going vertical. No stock and going to stay vertical for too long, but sometimes they go a little further than I think they're going to go. But I couldn't chase this move right now. I would really like to see this kind of stuff here. And if it can base in this kind of a pattern, you might get another big run like that. And so what'll happen is during the backing and filling here, if you were trading options, you would see a quick erosion of the value if you had call options when this occurred, because not only would implied volatility be coming out, but theta decay would be coming out as well. So yeah, I would like to see some backing and filling here first before going long. And if I caught that move, my temptation would be to take the gains. But again, everybody has different risk tolerances. So we'll see how it plays out over the next couple of days. But yeah, it's a heck of a move. And if you caught it, congratulations. It was a nice trade.
All righty. And right at 2 minutes after, we can transition over to the case study consideration for this week.
All right, we are going to borrow from the AI alerts again for this week, and we're going to do LIT. Um, so we've been doing um, uranium, gold, silver. We've been involved there. So might as well add lithium to the mix. A little bit of a pullback here, but most everything is in today's move. But we are separated from the 10-day moving average, so perhaps that's a pretty decent entry. You can see the ADX is up there. It's a little high, but it can stay there. I like the fact that the positive and negative directional indicators are still really separated. And even though there's just a little tick down in the positive directional indicator with a slight pullback today, the negative isn't ticking up. So it's more of a pause in the buyers than it is the sellers feeling emboldened and stepping in. Sellers don't seem to want anything to do with it right now, the shorts. So I think that one's going to be interesting to watch, and we'll look for it to head up towards that AI target around 65. AI has given it a 72% chance that we go there. So that's going to be our case study consideration for today. And that'll be an actual idea, Zach.
Alrighty, perfect. Well, I will take over the screen here and show everyone how to post the idea per usual. Alrighty, we should have my screen now. So here you are at the menu view, jumping off point of everything that this platform has to offer. For posting this week's official idea, as Rob stated, we'll go up to this right toolbar to the light bulb icon, which will bring us to a list of all of the ideas for the Hub platform that are currently published. We'll come over to the left toolbar where a new idea is available. And again, we have the option here to create an official idea as we're going to this week, which we can equate to paper trading as if you were executing a paper trade through your brokerage where all of the data, price quotes, everything is real time and accurate. It's just not any actual real risk or capital on the line. Or there's also the option to create a post, which is in this format can be viewed as a discussion board as the criteria for an official idea is not fully met. It's something to keep on the watch list. So we'll go over to create an official idea here. And that was a target price of
65.
65. As we go into the symbol search window here, we will type in our symbol for lithium. Target price of 65, as Rob said. And what's the time frame we're looking at for that, Rob?
We'll give it some time, so we'll do the 3 months.
3 months, so we'll go a quarter out in time. And as always, we will make this nice and pretty and more detailed right after this session concludes. But I am going to go ahead and confirm and publish this idea, so it's now available via the Hub platform for you to come in and interact. I've said this many sessions, so for those that have been around for a while, sorry to sound redundant, but for anyone that might be new or joining us for the first time, we just always want to encourage your interaction on the Hub platform, whether it be agreeing or disagreeing with the idea. Opposing opinions is what makes markets. If everyone agreed, there would be no transactions, no trades to take advantage of or have options on. There'd be no open interest or liquidity, as it would be in all buyers or all sellers market. So we always encourage your thoughts and opinions, and just, of course, include your supporting evidence and be considerate of the ever-growing community on the Hub platform. So I think that about wraps everything up for my dissertation on publishing the idea. I'll pass back over to you, Rob, to wrap things up.
All right, sounds great. Good job. And I do agree that the ever-growing social media aspect of the platform is really encouraging. I get a note from the Hub organization every time somebody else signs up, and it's daily. We're just adding people all the time, and it is a great community of people to bounce ideas off of, and it's a learning experience. I talked about if everybody agreed there'd be no markets, and sometimes you may have a viewpoint and you post it. Somebody has an opposing viewpoint and maybe makes a point that you weren't aware of or hadn't thought of. So from that aspect, it broadens your horizons and your knowledge base. So it's a good collective way to learn. So great, great feature, the social media aspect. So as always, thanks for your attention. We'll continue to monitor the government shutdown. Again, I don't know there's going to be a big deal until we get to the point where people start missing paychecks. That could change everything. So we're kind of ticking up and down after the initial morning sell-off, and we'll see how the market closes at the end of the day. Enjoy the rest of your trading day and look forward to talking again soon. Take care, everybody.